Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about InnovAge Holding Corp. Quarterly Report. InnovAge Holding Corp. offers a comprehensive range of medical and ancillary services for seniors who require care and support to live independently. The company's business model is centered around the program of all-inclusive care for the elderly PACE approach, which provides a holistic care experience. The services offered by InnovAge include in-home care, such as skilled, unskilled, and personal care, as well as in-center services like primary care, physical therapy, occupational therapy, speech therapy, dental services, mental health, and psychiatric services. Additionally, the company provides meals and activities for its participants. Transportation to and from PACE centers and third-party medical appointments is also available. InnovAge's care management services ensure that each participant receives a tailored plan of care that meets their unique needs. With operations in 6 states, Colorado, California, New Mexico, Pennsylvania, Florida, and Virginia, InnovAge has established itself as a leading provider of senior care services across the United States. The stock price of InnovAge Holding Corp. (INV) has experienced a significant surge of 52.53% over the past year, largely due to several positive news events that have boosted investor confidence. One key factor contributing to this increase was the company's strong fiscal second quarter 2026 results, which saw a swing to profitability, with net income reaching $10.6 million and revenue increasing by 14.7%. This exceeded analyst expectations, resulting in a 100% earnings surprise. The company also raised its full-year fiscal 2026 revenue guidance following these impressive results. In addition to the strong quarterly performance, InnovAge's improved cash flow and debt management have also contributed to the stock price increase. The company reported net cash provided by operating activities of $25.3 million for the 6 months ending December 2025, indicating a stronger financial position. Furthermore, InnovAge refinanced its term loan and extended debt maturities to August 2028, providing a sense of stability. The positive fiscal first quarter 2025 performance also played a role in setting a positive tone for the year, with revenue growth and significant improvement in adjusted EBITDA. Overall, these factors have combined to drive up investor confidence and contribute to the substantial increase in InnovAge Holding Corp's stock price over the past year. InnovAge Holding Corp. Market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. InnovAge Holding Corp. Trades at a higher price-to-book ratio of 3.26 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, a significant increase in capitation rates for both Medicaid and Medicare has contributed to revenue expansion. Additionally, an increase in member months, particularly in key markets such as California, Florida, and Colorado, has also driven growth. Furthermore, clinical and operational value initiatives have helped boost revenue. The census of PACE participants has also seen a notable increase, contributing to revenue growth. Moreover, the company's ability to maintain high participant satisfaction and retention rates has ensured steady revenue streams. Expansion through de novo centers within existing and new markets is another key driver of growth, subject to regulatory approvals. On the decline side, several factors have contributed to revenue contraction. The sales of certain product lines have decreased, while disruptions in supply chains due to the COVID-19 pandemic have also had a negative impact. Economic downturns and increased costs of care from third-party service providers have further exacerbated revenue decline. Labor market pressures and staffing costs have also taken a toll on revenue. The potential impacts of the OBBBA on federal Medicaid spending are another concern, although this is still speculative at present. Overall, the company's ability to adapt to these changing dynamics will be crucial in maintaining its revenue growth trajectory. Net income and profit margins show significant improvement in a notable turnaround. The company's net income has seen a substantial increase from -$19,201,000 in 2024 to $19,474,000 in 2025, representing an improvement of $38,675,000. This significant shift is a direct result of the company's efforts to revitalize its financial performance. The profit margins have also shown a marked improvement. The net income margin has increased by 8.7%, rising from -4.6% in 2024 to 4.1% in 2025. Similarly, the adjusted EBITDA margin has seen an increase of 5.4%, jumping from 3% in 2024 to 8.4% in 2025. These improvements are a testament to the company's ability to optimize its operations and manage costs effectively. The combined effect of these changes is a significant boost to the company's financial health, indicating a more stable and profitable future. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has achieved positive operating cash flow, marking a notable shift from previous years. In fact, for the 6 months ended December 31, 2025, the company generated $25,285 million in net cash provided by operating activities, a stark contrast to the -$763 million recorded in 2024. This substantial increase suggests that the company's operational efficiency and profitability have improved significantly. The positive operating cash flow is a testament to the company's ability to manage its finances effectively and generate sufficient cash from its core business activities. This development bodes well for the company's future prospects, indicating a strong foundation for continued growth and success. The company's debt level has experienced fluctuations over the past year. Initially, it decreased from $263.9 million to $238.7 million. However, in a later period, it increased from $215,087 to $220,859. The long-term debt also showed a slight decrease from $57,464 to $55,990. In contrast, interest expenses have shown a significant increase. According to the most recent information available, interest expense net was -$1,246 for the 3 months ended December 31, 2025, compared to -$760 in 2024. This represents an increase of $486. The conflicting information on interest expenses across different pages highlights the need for further clarification. Nonetheless, it is clear that the company's debt level has not changed significantly, but its interest expenses have increased substantially. The financial performance of InnovAge Holding Corp has shown significant improvement in recent periods. The combined East and West segments have been a standout performer, with notable gains in both the 3-month and 6-month periods ending December 31, 2025. In contrast to the previous year's losses, this segment reported net income of $10.6 billion for the 3 months and $18.6 billion for the 6 months in 2025. This marked a significant turnaround from the net losses of $13.20 billion and $18.10 billion recorded in the same periods of 2024. The improvement in this segment's performance is a positive indicator for InnovAge Holding Corp's overall financial health. Management is anticipating increased costs of care from third-party service providers due to budget pressures and potential increases in medical supplies. To offset these costs, they are implementing clinical value initiatives and operational value initiatives. Despite potential federal funding cuts and state restrictions on increasing provider taxes, management remains optimistic about the company's outlook. They plan to leverage fixed costs at existing centers to increase value over time and expand via de novo centers in new markets, pending regulatory approvals. To drive growth, the company intends to execute tuck-in acquisitions and strategic transactions. Management is also investing in increased headcount and wage rates to support growth, while implementing an organizational restructure and executive severance to improve efficiency. The company's financial performance has been strong, with a year-over-year increase in adjusted EBITDA and adjusted EBITDA margin due to increased census, capitation rates, and lower external provider costs. Management believes that their cash and cash equivalents and cash flows from operations will be sufficient to fund their operating and capital needs for the next 12 months and beyond. In terms of strategy, management is prioritizing business growth over shareholder returns, retaining substantially all available funds and future earnings to fund expansion and repay indebtedness. They do not anticipate paying cash dividends in the foreseeable future. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has expanded its customer relationships through unspecified business deals. Additionally, it acquired 4 PACE organizations, which brought in a total of 8 operational centers, excluding 1 center. Furthermore, certain pharmacy assets were obtained from Tabula Rasa Healthcare Group, Inc. These moves are expected to enhance the company's capabilities and market presence. On the other hand, the company has also divested itself of non-core activities through agreements with Grain RX, its former pharmacy services vendor. The non-renewal and termination of these services agreements have likely freed up resources for more strategic investments. The company's financial strategy has been focused on returning value to its shareholders through various means. One notable aspect is that it has not paid dividends, indicating a preference for retaining earnings within the business rather than distributing them as cash payments to investors. However, the company has also engaged in share buybacks, demonstrating its commitment to enhancing shareholder value through other methods. Specifically, $5.9 million was spent on repurchasing shares in the prior year, which can help to boost the company's stock price and reduce the number of outstanding shares. This approach suggests that management is confident in the company's future prospects and is willing to invest in its own equity to drive growth and increase returns for shareholders. That concludes the financial summary for InnovAge Holding Corp. Feel free to comment below, and I will be happy to answer them when possible.